Wouldn't it be great to see 6 months into the future? Now, while I can't give you a crystal ball, I can tell you this. Financial forecasting is the next best thing. When you take the time to forecast, you're no longer guessing about cash flow, upcoming expenses, or whether you could afford that next hire. You'll be making informed, confident decisions about your business. So, what exactly is financial forecasting? It's a process that helps you predict your revenue, expenses, and cash flow based on past trends and upcoming plans. Instead of reacting to financial surprises, you get to plan ahead, knowing what's likely to happen in the next few months. So why is this so important? It prevents cash shortages. You'll know if a slow season is coming and you can prepare. It guides your decisions, whether it's hiring, investing in new tools, or pricing changes. Forecasting helps you make informed choices, and it helps keep you ahead of the game. Instead of scrambling to pay expenses, taxes, or loans, you'll have a plan in place. So let's break it down into 6 simple steps. First, review your historical data. Start by looking at the past 6 to 12 months of revenue and expenses, and it'll give you a baseline for what's normal in your business. Second, identify recurring trends. Do you have a busy season? Is there a slow season? Are there certain costs that you sense are rising? Spotting these trends helps predict what's ahead. Third, project future income. Look at any new contracts, new potential clients, or maybe expected slowdowns. And be conservative. Hope for the best, plan for the worst. Next is estimate your expenses. Break them into 2 categories. First, fixed costs like salaries, recurring subscriptions, rent if you have a physical location, and variable costs like marketing or new software, travel expenses. Next is account for the one-time costs. Are there any big purchases, upcoming tax payments, or equipment or software or technology upgrades that are coming up? Those will need to be factored in so they don't catch you off guard. Last is build that cash flow plan. Once you have income and expenses projected, check for those cash flow gaps. Do you have enough resources to be able to cover the slower months? If not, now's the time to plan to be able to figure out how to bridge the gap. Luckily, you don't have to do all of this on your own and manually. Here are some tools to be able to make forecasting easier. There's accounting software out there like QuickBooks or Xero that help to be able to tell you, are there trends that are inside there by being able to log your historical data. Financial dashboards can help you visualize where your business is headed. And once you have those built, you should be able to keep leaning on those for really relevant data. And lastly, just relying on good old simple spreadsheets for those that prefer the more hands-on number crunch. Now, there are a couple of pitfalls to avoid. First, I mentioned it earlier, try to avoid being overly optimistic. It's much better to underestimate revenue than to overestimate it. Have the surprises be, wow, there's extra cash that we've got, rather than scrambling to be able to find dollars that you were expecting. Another pitfall is to ignore external factors, and that's absolutely true in a market like today. If the market is shifting, you're going to need to shift your forecast to be able to reflect that as well. And last, setting it and forgetting it. A forecast should be a living document and update it regularly. Don't look at it at just once a year and then just be surprised and disappointed that it didn't match. Make sure that you're using the information that you're learning to be able to tweak and edit that for the future. I get it. Forecasting isn't about getting it perfect. It's about being prepared. And businesses that plan ahead are far more likely to thrive, while those that don't will often find themselves scrambling. Now, if you want to create a simple, actionable forecast for your business and need some help, let's talk. Together, we can make sure that you have a plan for the next 6 months and beyond.